Welcome to the series featuring systematic traders in India. In the previous episode, we discussed about idea generation and taking those ideas to production. In this episode, Aamodh and I will look at the concept of market regimes and why it matters. We will take two examples, one a range breakout example with long options and one a 0DT option selling example, and see how the outcomes of these two strategies differ based on market regimes. So without further ado, let's get started. So disclaimers first. The ideas and examples shared in this episode are strictly for educational and illustrative purposes only. Nothing discussed here should be construed as a recommendation, investment advice, or a solicitation to trade. Trading in derivatives involves significant risk and can result in complete loss of capital. The examples and data presented are meant to explain market behavior, not to suggest that similar outcomes will occur in the future. Beyond the risk disclaimers, another thing. A basic understanding of options and options Greek is expected so that you can get the best value out of this conversation. With the disclaimer sorted, let's get started. Right now, I want to move to something else which I'm sure you would have noticed when we backtest a strategy. There are periods where a strategy consistently underperforms. It could be a few months, it could be sometimes longer than a month as well. There are certain strategies which fade out and die. But then most strategies, if they have a fundamental or foundational principle on the basis of which they are working, they may have periods where they don't work, but over the long run they do work. So now my question is, what is your view on these non-performing periods? What has been your experience?
So my experience has been that market regimes keep changing. And why do market regimes change?
So when you say market regime, give me a sense of what do you mean by that?
Okay. What I mean by market regime is basically the way for an intraday trader, it's the way price patterns happen through the course of the day. And there could be periods where you get trending price action in first half and calm price action in second half. There could be days, phases. When I say phases, I'm talking about maybe even months when first half is very volatile and second half is calm. There could be phases when first half is calm and second half trends big. And there was a phase recently, past few months, where post 2 p.m. you had very high volatility on 0DT days. I would call these phases as market regimes. When I say market regimes, there is no strict demarcation that this is a market regime, this is not, because you can't really demarcate that black and white, but it fades out and fades in, and somewhere you put a line and say, okay, a new market regime has begun. So strategies perform well in certain kinds of regimes and they don't in certain kinds of regimes. I would like to take example to say what I mean. We'll look at the data present on the screen, right? You have three strategies.
Okay.
Strategy 1, strategy 2, strategy 3. Forget what those strategies are for time being. Your risk per day, risk per trade is 0.75% in all three strategies.
Okay.
Your annual return, as you can see, is 18% in strategy 1. Historical annual return. It's not a guarantee of future annual return. There's no guarantees in the market. Historically, it has given 18.5%. Strategy 1 has given 18%, strategy 2 10%, 13%. You can see the expectancy and win rate of the strategies. The backtest duration is actually quite long in the sense that this has been backtested from February 2019 all the way till March 2026.
Okay.
Which is more than 7 years of
data.
Now, let's say you had to select one of these three strategies to trade from tomorrow. Which one would it be? Would it be strategy 1 because it has given the highest return? I think it makes sense to trade strategy 1 because it has given the highest return. But I would say we need to dig into data deeper to see what's the best strategy for the future.
Okay.
Let's dig a little deeper. So let's take this strategy, which is a range breakout from 9:16 a.m. to 10:15 a.m.
Okay.
And the range breakout is on the option strikes, at the money option strikes, call and put with 9:16 a.m. as the reference point.
Okay.
So if the range is from 9:16 a.m. to 10:15 a.m., if the range of the day gets broken out, then you buy that option and place a 25% stop loss on the entry premium.
Okay, so I have a question here,
Yeah.
Aamodh. So we have determined an initial range time-wise, 9:16 to 10:15.
Yeah.
Okay, so that is the range. Understood.
Yeah.
We are not taking a trade before that because the range is forming.
Yeah.
Now my question is, at 10:15, whenever the break happens, we start tracking option strikes 9:16, whatever was the at the money at that time, we start tracking that.
Yes, that's
And
right.
we'll wait for the breakout to happen on these strikes.
Yes,
Okay,
that's right.
got it.
That's right. So exit criteria is either it hits a 25% stop loss or you exit it at 3:15 p.m. at the end of the day.
Okay, and just one trade a day.
Maximum 2 trades a day, 1 call and 1
One
put.
put. Okay.
Whichever gets triggered gets traded.
Got it.
Maximum 2, and your position sizing is such that you risk 0.75% of your capital per trade,
Got it.
which means that a maximum of 1.5% risk per day.
Got it.
Right? And let's say today is August 2021. So you have data from 2019 February till August 2021. You backtest on this data and see whether the strategy has worked well, and then take a call whether to trade it next or not. And you backtest the strategy and you find the results are like this. You backtested it over 455 days, which is quite long, 31 months. From February 2019 to August 2021, it has given a return of 50% per annum at a maximum drawdown of 19%, which is a Kalmar of 2.61, expectancy 0.28. Beautiful numbers on paper.
Yep.
I think the next thing you would be dreaming of is buying a Lamborghini.
Absolutely.
So you decide to trade this as soon as possible. You start straight away. September 2021, you start this strategy. You continue trading this strategy till June 2023.
Okay.
Right? It has worked beautifully well in the past. There's no reason why it should not work in the future. Let's see what happened if you traded the same strategy in the next 23 odd months. This is how the strategy worked from 2019 to 2021 August. You see green months all around, green years all around. Drawdown has been recovered quite frequently, right? And now you traded the same strategy from September 2021 to June 2023. What gave you 50% returns per annum in your backtest window, right when you started trading it, has given you 2% loss per annum. You see that your dreams of Lamborghini are crashed and you have less money now. And what you observe here is that you have 0 stop loss hit days, 1 stop loss hit days, and 2 stop loss hit days.
Correct.
There. What you see that the percentage of times stop loss has gotten hit has increased in your latest trading window of 22 months. This kind of shows you that markets have not won. Okay, the other observation that you have is that win rate has reduced from 39% to 34%.
Got it.
So 2 things you can infer out of this possibly, that 1, the frequency of trending days has reduced because win rate has gone down. 2, the number of times the stop loss has gotten hit has increased. So frequency has reduced, and also look at the average reward to risk, the ratio of average winner to average loser. It has reduced big from 2.29 to 1.92. What that means is even in the trades that trended, the extent to which the trend has lasted has probably reduced. So this tells you that markets have changed in the duration that you have traded in relatively to the duration where you back tested. So you're wondering why this happened and all those things. Ideally, the usual suspect, the thing with market regimes is that you can identify market regimes by looking at data set, but the reasoning why the data set played out the way, it's very difficult to pinpoint and say it. You can only speculate this could be the reason.
And there may not be one singular reason. There could be multiple.
Markets are very complicated place where multiple players play the game with different time frame goals and different intents. Cannot really pinpoint, but one thing for sure is that the underlying price action regime has changed. It could be because of regulatory reasons, this, that, never know. So now you know that 25% stop loss is getting hit more frequently. Now you're thinking, okay, let me increase the stop loss to 50% instead of 25%. So you want to know whether it has worked or not, right? So you backtest this 50% stop loss in the same 2 windows of February 2019 to August 2021 and September 2021 to June 2023.
Got it.
So let's see how that played out. So in this table, you have 25% stop loss and 50% stop loss data.
Got it.
Right? Over these 2 windows. you see that while 25% stop loss had a annual return of, there's a typo there, it should be minus 2.5%.
Okay.
The 50% stop loss has given you 4.7% annual return in the same window. You are already in pain, you are in search of profit, you decide, okay, this is doing better, this has higher chances of performing in the current market regime, and I'll trade 50% stop loss instead of 25% stop loss because this has been profitable in the recent regime. And let's say you decide to trade this from say July 2023 all the way till December 2025. Let's see what happened if you traded 50% stop loss. All other rules are the same. It's an intraday strategy. 50% stop loss, opening range breakout 9:15 to 10:16 p.m. And this is what you see. 21% return in the first window, 4.7% return in the second window, but in the window that you traded live, you are down 7% annually. Market regime probably again changed. Now you are left wondering what actually works. Obviously,
Market did not accommodate even a 50% stop loss in a way.
Yeah, right. So even a 50% stop loss has looked too tight. Now, you're wondering why should you even have a stop loss? In a short option strategy, not having a stop loss in place is disastrous because the potential risk if an adverse move happens is disastrous. It's infinite risk thing, theoretically.
Correct.
Right? But this is a long option strategy. The maximum you can lose is the entry premium which you have bought. Assuming your execution is sound, you don't place market orders and use limit orders to enter, you will get defined risk-defined entry premiums. And now you're thinking, okay, 50% stop loss did not work. How about 100% stop loss?
Which is no stop loss in
Yeah, no stop loss. You're just you're doing a range breakout 9:15 a.m. to 10:15 a.m.
letting it run.
If you're putting a 25% stop loss and risking 0.75% of your capital per trade, let's say you can trade 12 lots with the 50% stop loss, you can only trade 6 lots.
Correct.
Because you're risking higher premium per lot.
Got it.
With a 100% stop loss,
you will trade 3 lots.
Yeah, 3 lots. That sizing is taken.
So you're still managing the risk through sizing.
Right.
Got it.
Through sizing, the risk is managed. This is an intraday strategy. You can get deterministic exit points. You can't take this strategy positional.
Got it.
If you take this strategy positional, then your 25% stop loss or 50% stop loss would not get honored
Got
on
it.
an adverse gap.
Got it.
But now that you are considering 100% premium as the risk, you can as well afford to take it positional, right? You already planned for that 100% premium loss. So you decide, okay, let me backtest 100% stop loss for all these 3 windows and see how it worked. If it worked well, let me trade it live from 2025 January onwards.
Okay.
You do that backtest and you see that 100% stop loss in the backtest window, which is the table you have, 3 strategies, has given 8% per annum in this latest duration in which both 25% stop loss has been negative and 50% stop loss has been negative. Now you take your final chance. You say you can't go more than 100% stop loss in long option. You say, okay, let me try this out from January 2025 and you trade this, right? And let's see what happened from January 2025 till March 2026.
Okay.
If you did a long option range breakout 9:15 to 10:15 with 100% premium as risk, it has actually given better returns than in the past. You can see that market regimes have changed over the years. Maybe there are more gaps happening in the recent year which may not happen in future.
I understand the 100% stop loss data that you're showing is positional because we are holding it till the next day. So at what point next day are we exiting it?
Yeah, so we are exiting it straight away at 9:20 a.m. Next day.
So what if I had not gone positional, 100% stop loss, but exiting at 320 or one of those intraday exits? How would it have performed?
So I have backtested it. I haven't shown the data here. So it has performed better than 50% intraday stop loss, but its performance has not been better than 100% positional thing, because with the positional, you are holding it for a longer window and gaps add to the profit. And so 100% stop loss intraday exit has given lesser profit than 100% stop loss positional. But more profit than the 50% and 25% intraday.
Got it. So here you are trying to get the gap advantage in your favor.
Yes, that's right. Now you see that the one that has performed well across the regimes is 100% stop loss positional. Now let's go back to the question that I had asked earlier. I had shown 3 strategies and asked which one would you trade in future.
Correct.
Whether it would be the one that has given the highest returns. In case your answer was yes, then let's deep dive and look at how it has done over the regimes.
Got it.
So here's the bar graph of each of these 3 strategies over different regimes, the annual returns graph.
Mm-hmm.
You can see that 25% stop loss has given the best return over the 7-year window. But if you look at the distribution of the returns over different market regimes, it's on a downtrend. It has given negative returns in the mid part in that graph, and in the recent past, it has been profitable, but surely not as its past or the others, right? You look at 50% intraday, which was strategy 2 in the table. Strategy 1 in the table was 25% stop loss intraday. Strategy 2 was 50% stop loss intraday. Strategy 3 was 100% stop loss intraday.
Got it. So the one with the highest expectancy was 100%.
The one with the highest expectancy was 100%, yes.
Got it.
The one with the highest expectancy was 100%, but the one with the highest returns was 25% intraday. You look at this graph now, and the trend that you see is that 100% stop loss positional has been the most consistent performer over the regimes, which means that it is more robust than others. And more importantly, in the recent regime, it is the one that has outperformed both the rest of the strategies as well as itself. So personally, I ask myself the question, which one would I trade? My personal inclination would be on the one that has performed in the recent regime well, and the one whose performance has been relatively better to itself, its past, which is 100% stop loss positional. We can have 3 takeaways from this. One is that over the years, the amount of trending days has reduced and the extent of the intraday has also gone down.
Okay.
Markets have become choppy in nature. You are better off if you have a decently wide stop loss compared to a tight stop loss.
Mm-hmm.
That's how data has played out. It's not that in future this is going to play out.
Mm-hmm.
There is always a risk of regime changing. Regimes tend to be sticky in nature. You play until the stickiness lasts. The third, the most important conclusion or the takeaway, if I had to look at this, is that the highest profitable strategy in the past need not be the best alternative for future. The best alternative for future is likely to be the one that has performed the best in the current market environment.
Mm-hmm.
Right? So you ideally need to do a good in-sample, out-sample analysis. What I have done by splitting these states is directly or indirectly an in-sample, out-sample analysis.
Okay.
You would need to do that before selecting the strategy that you're going to trade live.
Give me an example of how would you divide the in-sample and out-sample time periods?
So there are multiple ways to do this. One is like you can take regime. Okay, how did I split these to these specific dates? Right? It's purely discretionary. I have done it at my discretion based on my reading of the market. February 2019 till August 2021, you had high intraday leverage, right? And you had less participation of all the 920 straddlers and time-based straddles. Retail option participation was relatively low. So that is that regime how I have demarcated. And September 2021 till June 2023, I have demarcated it as a intraday leverage removal regime. And also FinNifty 0DT expiry got introduced. July 2023 to December 2025 is what I consider as the daily 0DT regime. You had 5 different index weekly expiries running. And January 2026 till date is what I call the higher 0DT ELM margin regime, and you have other regulatory changes like daily 0DT removal.
And general high volatility.
Yeah, high volatility, and the contract size is higher, right?
Got it.
And April 1st, 2026 onwards, you'll probably have a different regime, which is you have increased STT and there are some other regulations that are changing, right? Coming back to in-sample, out-sample, how can it be done? One is you split across different regimes and see how it has
the strategy
performed.
performs.
You can take the first 3 regimes as in-sample and fourth one as out-sample. first two as in sample and the second two as out sample. Multiple things you can do. The other thing is that you can do a rolling window analysis, right? You can rolling window rebalancing frequency analysis. You can take a 2-year rolling window and rebalance that rolling window across, let's say, 1 month, 2 months, 3 months, and see which one has done consistently across
better.
Different rolling windows.
Got
You
it.
can do these kind of things.
Going back to this 100%
Yeah.
no stop loss positional approach, I was just thinking aloud because personally I do play with a lot of this index data.
Yep.
Why do you think it is the most consistent?
One factor could be that gaps have been favorable. Historically, majority of the returns, the Nifty points-wise returns has come overnight compared to intraday, right? So if you're taking a position of a positive expectancy strategy overnight, it can add up to the numbers. That's one thing. And second thing is, in general, your average points per trade is proportional to your holding duration. When you take a strategy positional, your holding duration has increased, and that can add up as well.
Yeah, because you're taking more risk. I mean, it is compensating for that overnight risk.
Correct. It's compensating for that overnight risk. Key thing though here is not just that this positional strategy has done across the years. You can also see that it has higher expectancy compared to the other ones over the years. I treat expectancy as a proxy for profit margin. Higher expectancy need not give higher profit, but with higher volumes, it can give you higher profit because that's higher profit margin.
Now, one of the things, Aamodh, I did not notice in these backtests is, do you split between directionally? So this is ORB. In one of my ORB backtests, I typically split it between long side and, I mean, when I say long side means on the Nifty going up versus Nifty going down. Okay. So did you try to do that and see any patterns, directionally speaking?
Yeah. So for this particular strategy, I haven't done that analysis, but I tried a lot of intraday systems, and in general, what I've observed is that intraday shorts make more money than longs.
Okay.
Overnight longs make more money than shorts.
Which is what is the general pattern.
Yeah.
But then off late, I'm seeing some change there as well. Okay. So, I mean, of course, this past few months, past few months are bad because markets are going down both ways.
Yeah.
So we are, there is gap down and then there is continuation, which is happening. But then there are regimes where this changes is what I see, where, you can go long intraday and it'll work. Yeah. So it's not necessary that.
Yeah. So I would ask myself the question, what's the first principle running it? When we look at 2 months, to be honest, it's too short.
Correct.
Not enough, not large enough sample data to take it seriously. Unless I can explain why it is happening the way it is happening, I wouldn't like to trade it.
Makes sense. Makes sense. With that, we come towards the end of this part 2 of the series where we discussed market regimes and its impact on range breakout strategies. In the next part, we will look at market regimes again and its impact on option selling or time-based straddles kind of strategies. I hope you found this episode useful and interesting. If you have any questions, thoughts, or comments, please feel free to respond in the comments and I would do my best to respond. Thank you.